There's something deeply frustrating about watching someone less intelligent than you, someone less educated, someone who seems to understand nothing about markets or economics or sophisticated investing strategies, accumulate wealth while you, with all your knowledge and analysis and careful planning, stay broke. You read the right books, you follow the smart investors. You understand compound interest and tax optimization and modern portfolio theory. And yet, somehow, the guy who barely graduated high school, who's never read a financial book in his life, who puts his money in the most boring, obvious investments imaginable, is worth 10 times what you are. And this isn't a rare phenomenon. This is a pattern that reveals something uncomfortable about the relationship between intelligence and wealth. Because the truth is, intelligence often works against wealth building. And boring, systematic, almost mindless consistency is what actually makes people rich. Warren Buffett is one of the smartest investors who ever lived. And yet, if you look at how he actually invests, it's incredibly boring. He buys stocks in simple businesses that anyone can understand. Coca-Cola sells sugar water, Geico sells insurance, See's Candies sells chocolate. He holds these investments for decades. He doesn't trade. He doesn't try to time the market. He doesn't use complex strategies or derivatives or leverage, at least not in ways that most people think about leverage. His approach is so simple, so obvious, so boring, that people assume there must be something more to it, some secret they're missing, but there isn't. The simplicity is the secret. The boring consistency is what creates wealth. And smart people can't accept this because it feels beneath them. It feels like a waste of their intelligence. Let me show you exactly how this plays out. Imagine two people. Person A is brilliant, high IQ, reads constantly, understands nuanced economic theories, follows the markets obsessively, can tell you why the Federal Reserve's policies will cause inflation or deflation, can analyze balance sheets, knows technical analysis and fundamental analysis, and can debate the merits of growth versus value investing. This person is always looking for an edge, always trying to be smarter than the market, always searching for the next opportunity that no one else sees. And because they're smart, they find these opportunities. Or at least they think they do. They buy the hot tech stock that's going to revolutionize everything. They invest in the cryptocurrency that has brilliant developers behind it. They find the small cap company that's undervalued by the market. And sometimes these bets work. Sometimes they make 50% or 100% on an investment. And that reinforces their belief that being smart and finding these opportunities is how you get rich. But here's what actually happens over time. For every investment that works brilliantly, there are 3 or 4 that fail. The hot tech stock crashes when the hype fades. The cryptocurrency turns out to be vapor or gets hacked, or regulatory issues kill it. The small cap company was cheap for a reason, and it stays cheap or goes bankrupt. But the brilliant person doesn't see this as their strategy failing. They see it as individual mistakes. Bad luck. They were right about the analysis but wrong about the timing. Or there was some piece of information they didn't have. So they keep doing the same thing. Keep trying to be clever. Keep looking for the big win. And they're constantly in motion. Buying and selling. Moving from one opportunity to the next. Never boring. Always active. And after 20 years of this, they look at their net worth and they're shocked. Despite all their intelligence, despite all their effort, despite those few big wins they had, they've barely accumulated any wealth. They've spent 2 decades spinning their wheels. Now take person B, not particularly bright, never understood economics, doesn't follow the news, doesn't care about the Federal Reserve, has never analyzed a balance sheet. But 25 years ago, someone told them to put 10% of every paycheck into a 401k and invest it in a target date retirement fund. And they did. Not because they understood why, not because they analyzed whether it was the optimal strategy, but because it seemed like the safe, simple thing to do. So every 2 weeks, 10% comes out of their paycheck They don't think about it. They don't look at the account. They don't get excited when it goes up or panic when it goes down. They just let it happen. For 25 years, and at the end of those 25 years, they log in to check their balance, and they have $800,000. Maybe $1 million if they got raises over the years, and the 10% grew with their income. And they're shocked because they didn't do anything. They weren't smart. They weren't strategic. They were just boringly consistent. And that boring consistency created wealth that the brilliant, active, constantly thinking person never achieved. This is the paradox. Intelligence makes you think you need to do something special, something that other people aren't doing, something that takes advantage of your unique insights. And that impulse, that need to be clever, it destroys wealth. Because wealth isn't built through cleverness. It's built through boring, systematic, repetitive actions over a very long time. And smart people get bored. They can't stand doing the same simple thing for decades. It feels like a waste of their capabilities, so they deviate. They try to improve the strategy. They try to be clever. And every deviation, every attempt to be smart, it introduces risk. It introduces the possibility of being wrong. And when you're wrong, you lose money. And those losses compound just like gains do. Warren Buffett has said that investing is simple but not easy. And smart people misunderstand this quote. They think he means it's intellectually simple but emotionally difficult. But that's not quite, right? It's simple in the sense that the actions required are not complex. Buy good assets at reasonable prices and hold them for a long time. That's it, but it's not easy because humans are wired to do the opposite. We're wired to take action, to react, to be clever, to do something. And smart people are especially susceptible to this because they have the capability to be clever. They can come up with sophisticated reasons why they should deviate from the simple, boring strategy. They can analyze themselves into bad decisions. And that's exactly what they do. Let me give you a concrete example of how this plays out with something everyone understands. Real estate. Smart person approaches real estate investing by trying to find the perfect deal. They research markets obsessively. They're looking for emerging neighborhoods. They want to buy below market value. They want to find the property that no one else recognizes as valuable. They spend months or years looking for this perfect opportunity, and maybe they find it. Maybe they buy a property for $300,000 that's really worth $350,000. They feel brilliant. But here's what they didn't consider. While they were searching for the perfect deal, the boring person bought a normal property in a good area at market price 2 years ago. They paid fair value. Nothing special, nothing clever. But real estate in good areas appreciates over time, and rents cover the mortgage. So over those 2 years, while the smart person was still searching, the boring person's property went up $50,000 in value. The equity for mortgage paydown and appreciation is more than the smart person saved by finding their clever deal. And the boring person is 2 years ahead in terms of time in the market. They're building wealth while the smart person is still being clever. And this pattern repeats across everything. The smart person wants to time the stock market. They're going to buy low and sell high. They're going to be defensive before crashes and aggressive after. And sometimes they're right, but often they're wrong. And the cost of being wrong, the cost of being out of the market during rallies, it exceeds the benefit of avoiding some declines. The boring person just stays invested. They don't try to time anything. They buy automatically every month through their paycheck regardless of whether the market is high or low. And over decades, they capture all the market's returns. They never miss a rally. They never sit in cash, earning nothing while stocks go up 20%. The smart person misses those rallies because they were being clever. They were waiting for a better entry point. And that waiting cost them more than the crashes they avoided. Here's another way smart people sabotage themselves. They optimize. For the wrong things, they spend enormous amounts of time and mental energy trying to squeeze out an extra 0.5% of return. They'll research which index fund has the lowest expense ratio. They'll debate whether a 0.04% fee is better than 0.05%. They'll spend hours doing tax loss harvesting to save a few $100s. And all of this is fine in theory. But it's missing the point. Because the difference between a 0.04% fee and a 0.05% fee on a $100,000 portfolio is $10 a year. $10. And these smart people are spending hours, days, weeks obsessing over this $10 while missing the fundamental drivers of wealth, which are how much you save and how long you let it compound. The boring person saves 15% of their income consistently. They don't optimize. They just save. And that 15% versus the smart person's 10%. Who's spending the other 5% because they think they'll make up for it with clever investing. That 5% difference in savings rate is worth infinitely more than optimizing expense ratios. This is what Warren Buffett means when he talks about keeping things simple. He's not saying you should be stupid. He's saying you should resist the urge to be clever. Because cleverness introduces complexity. And complexity introduces more ways to be wrong. If you have a simple strategy, buy index funds every month and never sell, there's only one way it can fail. The entire global economy has to permanently collapse. And if that happens, nothing you did would have saved you anyway. But if you have a complex strategy with 10 moving parts, there are 10 different ways it can fail. You can be wrong about market timing. You can be wrong about stock picking. You can be wrong about sector rotation. You can be wrong about international versus domestic. Every layer of complexity is another opportunity for error. And smart people add layers because they think they're reducing risk, but they're actually increasing it. Let me tell you what rich, boring people do. They pick a simple, proven strategy, and they execute it for decades without deviation. And I mean without any deviation. They don't get bored. They don't get tempted by better opportunities. They don't think they're smarter than the strategy. They just do it. Month after month, year after year, decade after decade. A typical example. Married couple, both working modest jobs, combined income of $90,000. They live on $60,000 and invest $30,000 every year. Where do they invest it? 70% in a total stock market index fund, 30% in a total bond market index fund. They rebalance once a year. That's it. That's an entire strategy. No stock picking, no market timing, no real estate, no cryptocurrency, no alternative investments. Just boring index funds, bought consistently, held forever, and after 30 years, they have $2 million. They're rich, not because they were smart, but because they were boring. And here's the kicker. The smart people look at this and say, well, I could have done better. If I'd picked the right stocks, if I'd timed the market correctly, if I'd gotten into Bitcoin early, I could have 10 million instead of 2 million. And maybe that's true. But the question isn't what the theoretical optimal strategy was in hindsight. The question is what strategy you can actually execute in real time without screwing it up. And for most people, especially smart people, complex strategies don't get executed properly. They get abandoned when they're not working. They get tweaked when they should be left alone. They get sabotaged by cleverness. The boring strategy doesn't have those problems because there's nothing to sabotage. It's too simple to mess up. Warren Buffett's business partner Charlie Munger has said that the first rule of compounding is never interrupt it unnecessarily. And smart people interrupt compounding constantly. They interrupt it by selling when they think the market's too high. They interrupt it by switching strategies when their current approach isn't working fast enough. They interrupt it by taking money out to invest in some new opportunity. Every interruption, every deviation, every clever move, it breaks the compounding. It restarts the clock. And compounding is most powerful in the later years. The difference between 25 years of uninterrupted compounding and 30 years is enormous. Those last 5 years might account for a third of your total wealth. But smart people never make it to 30 years because they keep interrupting. They're never boring enough to let it run. Now, let's talk about what boring actually means in this context, because I think people misunderstand it. Boring doesn't mean stupid. Boring doesn't mean you're not educated. Boring means you've made a decision and you're sticking with it regardless of what else is happening. Boring means you're not reactive. You're not constantly reconsidering. You're not tempted by the new thing. Warren Buffett is incredibly knowledgeable about business and markets and economics, but his investment strategy is boring. He buys wonderful businesses at fair prices and holds them forever. That's it. He doesn't deviate. He doesn't get clever. Even when everyone's making money on tech stocks in the late 90s and Buffett's approach looks outdated, he stays boring. He doesn't buy the tech bubble. And everyone calls him washed up, past his prime, out of touch. And then the bubble crashes and suddenly he's a genius again. Not because he did anything, but because he stayed boring while everyone else got clever. This is the test of whether you can be successfully boring. Can you stick with your strategy when it looks wrong? When other people are making money doing something different? When you feel like an idiot for not participating? That's when boring is hardest. That's when smart people break. Because they can see the logical case for the new thing. They can construct a sophisticated argument for why this time is different. Why they should deviate from their boring plan. And that intelligence, that ability to construct convincing arguments for deviation, that's what makes smart people poor. Here's what you need to understand. The market is designed to make smart people feel stupid. The boring strategy will underperform something in any given year. In 2021, if you were boringly invested in index funds, you probably made 20%, though sounds great, until you see that your friend who bought Tesla or GameStop or some cryptocurrency made 300%. Your smart brain tells you you did something wrong. You should have seen that opportunity. You should have been in those things. And that feeling, that sense of having missed out, that's what causes you to deviate from boring. That's what causes you to start chasing performance. And chasing performance is how wealth gets destroyed. The boring person doesn't care that their friend made 300%. They don't even think about it. They're making their automatic contribution every month to their index funds, and that's the end of their financial thought process. They're not smart enough to feel like they should be doing something more sophisticated. They don't have the curse of intelligence that makes everything simple feel insufficient. They just do the boring thing. And over decades, the boring thing wins. Not because it's optimal in any given year, but because it's sustainable. Because you can do it forever without emotional burnout or decision fatigue or the constant second guessing that smart people endure. Let me give you the most important insight in this entire discussion. Wealth building is not an intelligence test. It's a behavior test. It's not about being smart enough to pick the right investments. It's about being disciplined enough to stick with a good enough strategy for a very long time. And discipline is not correlated with intelligence. In fact, they might be negatively correlated, because intelligent people can always think of reasons why discipline isn't necessary in their case, why they can break the rules, why their situation is special. The boring person doesn't have those thoughts. They just follow the rule because it's the rule. In that mindless rule following, that boring consistency, that's what creates wealth. Warren Buffett has recommended that normal people invest in index funds and never sell them. That's his advice. Not pick stocks like he does. Not analyze businesses. Just buy index funds and hold. Smart people hear this and think, well, that's advice for average people. I'm smarter than that. I can do what Buffett does. I can pick stocks. And that's where they go wrong. Because picking stocks requires not just intelligence, but a specific kind of temperament that's extremely rare. Buffett has it. You probably don't. And even if you do have the intelligence to analyze businesses, do you have the discipline to hold through 50% drawdowns? Do you have the patience to wait years for an investment thesis to play out? Do you have the emotional control to ignore what everyone else is doing? Probably not. Which means you should do the boring thing. But your intelligence tells you you're too smart for the boring thing, and that's why you're poor. So here's what you should actually do if you recognize yourself in this. If you're smart and you realize that your intelligence is working against your wealth building, first, accept that boring is not beneath you. Boring is optimal for almost everyone, including smart people. Second, pick a boring strategy. Total market index funds. 60% stocks, 40% bonds. Or 80, or whatever allocation makes sense for your age and risk tolerance. But make it simple. 1 or 2 funds. Third, automate it. Set up automatic investments from every paycheck. You never see the money. It just goes to investments. Fourth, and this is the hardest part, commit to never deviating. Not when something else looks better. Not when you think you see an opportunity. Not when you feel like your strategy is underperforming. Never. You picked a good enough strategy. You're going to execute it for 40 years, and you're going to become wealthy not because you were smart, but because you were boring. This is what successful investors who aren't geniuses have figured out. They've figured out that they don't need to be smart. They just need to not be stupid. And not being stupid means not deviating from a simple, proven plan. It means resisting the urge to be clever. It means being comfortable with boring. And if you can do that, if you can be boring for decades, you'll be rich. Not as rich as if you'd perfectly timed every market cycle and picked every winning stock and gotten into every trend at the perfect moment, but richer than the smart person who tried to do all those things and failed most of the time. Richer than the person who spent decades being clever and has nothing to show for it. The boring person wins. Every time. Over any meaningful time period. And once you accept this, once you embrace boring, wealth building becomes almost automatic. Because you're not fighting against yourself anymore. You're not trying to be smarter than you need to be. You're just being consistent. And consistency over decades is how ordinary people become millionaires.